Hey guys, Rob Tatro here from robtatro.com, award-winning portfolio manager, Canaccord Genuity Wealth Management, and at the Tatro Wealth Advisory Group. Good day. Thanks for coming. Thanks for being here. I am really excited. We're about to dig deep here into business succession planning. So this is a masterclass. So if you've never done this, basically what's going to happen is I'm going to give you some tips, pointers. I'm going to go through a deck, some talking points. I'm going to give you some free advice here. You grab maybe a pen, pencil, paper, whatever you need to take some notes, take some on your laptop, your iPad, whatever you're watching on. Gather this free information here. And we got this for you today. We're going to be taking care of the free piece of advice that you need to know for business succession. So if you're planning on selling a business in the near future. So I'm excited. It's going to be fun. It's going to be good. And of course, best of all for you guys, it's free. So thanks for tuning in. Let's get right down to it. Enough about me, enough about chatting. Let's get to it. So what can you expect from this class? So obviously you're going to get complete info on clarity on benefits of proper preparation and business succession planning. We're going to take a look at the importance of a team approach. So that means, partnering with your accountants, your financial advisor, your lawyers, your portfolio manager, etc. Also means how to set up your estate efficiently for your taxes before and after your debt. Clarity on how to properly address the transitional wealth among family members after the sale of a business. Huge point. Learn how proper business succession planning can save tens, if not hundreds of thousands of dollars. I'm not kidding. This has happened to me for one client. I'll never forget. The tax savings was $600,000 for this client. I'll never ever forget it. That client to this day sends me a gift every year at Christmas just because of that. But we see it all the time, right? And, my background as a lawyer, I used to practice law. I've seen so many of these. And in my days now, the last 11 years as a portfolio manager, doing these types of due diligence experiments and working with clients to find out the optimal way to do business succession planning, that's why we can give this advice. I've seen it. I've seen so many of them from both sides of the table, from both sides of the equation. I've also sold businesses too. So I could tell you a lot about this. So finally, we're going to give you advice on tax planning before the business is sold. So we're also going to give you a business sale checklist and estate freezes. So this is not for you if you're not planning on, or you don't own a business, or you never will, or you're not planning on ever selling it, or maybe you could do it yourself. You don't need expert advice, or you don't have the operational ability to sell it as a functioning business, or you're not interested in any way about learning about the tax issues. It's not for you. However, this is for you if you don't already have a comprehensive business succession plan in place. You're not sure how this important asset can be sold, transitioned, or liquidated. You're a business owner, right? And you've built this huge asset, which is your business. You've done it over the course of your lifetime, or maybe over the last 5 years, or maybe the last 20 years. Regardless, it's now time to cash out on this wealth that you've created inside of your business, inside of your corp, hopefully. And now you're looking for professional guidance on how to build a custom business succession plan in order to save on taxes, put more money in your pocket. Maybe you're not sure how to prepare and plan financially during retirement after the sale of the business. And maybe you're not sure how to structure the transition of the operation to a stranger and to a family member. Those are two completely different things, and stuff that you definitely need to start thinking about if you haven't already. Finally, maybe you're unhappy with the service and the advice you're getting from your current advisor, or maybe you don't have an advisor, or maybe you don't even understand that there are guys like me out there who do this kind of stuff. You're at the right spot. All right. So disclaimer here, this is important. I am not an accountant, although I do have a finance MBA, and I took a lot of accounting courses, and I got an A+ in financial and managerial accounting. I'm not an accountant. My brother is one and my mom is one, but that does not make me an accountant. Also, I no longer am an active member of the Manitoba Bar. I am an inactive member, so therefore I'm no longer practicing and can no longer give legal advice. I am a portfolio manager. I do have a CIM designation. This preparation was prepared in conjunction with a CFP, Certified Financial Planner. I had input from estate planners, mortgage brokers, all sorts of experts for the presentation. But myself, just remember that I'm not an accountant. Okay. Let's keep going here. So this is me. This is Rob Tatro. I'm head of the award-winning Tatro Wealth Advisor Group. It says multi-award-winning. I like that. That's pretty good. We've won a whole bunch of stuff. Portfolio Manager of the Year, one of the fastest growing practices in the entire country, if not the fastest. We've consistently been on Wealth Professionals, either their top 50, but they also narrowed down to top 2, top 6, etc. So we do have a very strong track record when it comes to this. And like I said, former lawyer also. So I've seen the deals from the other side as well. This here talks about, it says family man, wife and 4 kids. Yeah, my wife, Michelle, my lovely wife, Michelle, 4 kids, a former national champion of Settlers of Catan and chess, former lawyer at MLT Aikens, finance MBA, Dean's List. I'm currently a portfolio manager. I have a CIM designation. I'm also a fellow of the Canadian Securities Institute. I am founder and president of the Canadian CMV Foundation. That is a charity that has as its goal the eradication of the #1 cause of infant disability. And it's a congenital birth defect. My son was born with it. My wife and I dedicated our spare time, if you will, in our life to eradicating this. So we founded this charity. We've raised about $700,000 and we've successfully passed legislation to get change. That's part of what I do in my spare time. I'm a branch manager here at Canaccord Genuity Wealth Management. I'm head of the Tatro Wealth Advisor Group. I'm also a board member of the provincial IROC board. IROC is our regulatory body. It's the Investment Industry Regulatory Organization of Canada. I'm on the provincial board. So we make decisions, that impact. It's the regulatory aspect of it. So, we put the bad guys in jail and we make sure advisors are being compliant in our industry. As I keep going here, going to get into some of our awards here. There's a bunch of them here. I think what you need to know is consistently been in the top 5 wealth professionals, top 50 advisors. I was portfolio manager of the entire country. I've been nominated other stuff, philanthropy, community service, digital innovation, asset growth, all sorts of stuff on here, community awards as well, provincial awards as well, and some national awards there for you too. This is the Tatro Show. So I also run the Tatro Show, which is a weekly show. It runs Monday at 3 Eastern. There's some guys that have been on the show. Mark Leishman, professional golfer. He's a fun cat. Vincenzo Guzzo, Bruce Croxton, Michael Hainsworth. Bruce Croxton was a dragon. Vincenzo Guzzo, also a current dragon. So it's a fun show. If you're bored, check it out. These guys come on my show. It's fun. The Tatro Show. Now let's get into more stuff here. Philanthropy and fundraising. This is me. It's a deep belief that I have. I talk here about BNN and Bloomberg. The reason I'm doing this is not to toot my own horn. I just want you to know, if you're spending this time to join this masterclass, I want you to know that you're not just watching some schmuck, right? Like, it's a guy that has a finance MBA, lawyer, has been on nationally syndicated, on BNN, the Business News Network. I'm a guest host. I've been on Market Call. I've done pretty much every show on BNN that they have. I flew down to Toronto many times to do it. I also do it from Winnipeg. I've been in the Globe and Mail, the Winnipeg Free Press. I've been in CBC, you name it. I've pretty much done every spoken global TV every single morning at 8:06. So I just want you to know that I'm legit, I guess. Now, it's never too early to begin thinking about a succession plan for your business. This is incredibly important. That's why you're here. Obviously, you're thinking about it. You want to know what you should do. And that's why you're here. So I'll give you a quick story when we start. So John and Ann, they had a business. They were the owners. They approached us for a second opinion on the sale of their operation, how they could minimize taxes paid. Also needed help with their estate planning, setting up a family trust. They wanted to optimize their risk-adjusted investment portfolios. I can tell you, though, they had no idea about all this stuff. We had to tell them about their trust. We had to tell them about how to set up a corporation. In fact, we had advised them 6 or 7 years earlier to incorporate the business for the eventual potential sale of the campground. So not only did their assets right here end up, so if I keep going here, they had ample resources for their needs. However, they were advised to focus solely on drawing down their corporate savings before accessing any other capital. Was it the right approach? So had a plan been done? Should their cash flow come? Where should it come from? Had the investment asset allocation been optimized? Those were just a few of the questions that we needed to address in order to provide them with guidance. And obviously what ended up happening is John and Ann, as we went through it, we reviewed their goals, their objectives, their lifestyle costs. And, we focused down on drawing RSPs first, accessing some non-registered funds to the balance, ended up saving them $300,000 lifetime in income tax savings. This is an addition to the several $100,000 that we saved with proper business succession planning advice, because we met with them before they were selling their business, properly incorporated, properly did the estate freeze, properly set up the family trust, were able to benefit from the capital gains exemption. If I recall, the number was, I believe it was 200 times. So I believe it was $600,000 in capital gains savings, in addition to the $300,000 in lifetime income tax savings for this couple. So this is a story that happens all the time. All the time. My clients, most of them are extremely wealthy and they're very good at a few things, but one of them is running their business. They're good at doing that. They're good at creating wealth in their business. They've built a business. This kind of stuff for most people is secondary, right? Do I have the right tax structure? Who cares? My business is going well. That's what I care about. Most of the business owners I deal with are passionate about their business. That's what they know. That's what they understand. That's what they want to focus on. So what ends up happening? Well, they end up happening is you get some sort of offer at some point. Some Godfather offer drops on your door, $5 million, $10 million for your business. And, do you accept that? You start thinking, you know what? I'm 56. We've had a good run here. Maybe I take the 5 mil, maybe buy a place in Phoenix. Maybe we retire. Let's do that. Whoa, pump the brakes, because if you've not done the proper planning, you can take the 5 mil. Obviously, you're going to take the 5 mil if you think it's a great number, but you might just be paying a heck of a lot more in taxes. So this happens all the time. So proper planning, I tell all of my clients when they become clients that own businesses, proper planning is critical. Let's make sure we're in place, we're set up so that if ever you do get, that Godfather offer, you can choose to accept it if you want, and you can do it in the most tax efficient way possible. So John and Ann, hundreds and hundreds and hundreds of thousands of dollars of taxes. It's one story, one example how we can help the owners maximize profits, minimize taxes, structure their estate plan in order to leave a legacy that they've always dreamt of leaving for the next generation. So legacy is a whole other topic that, maybe we could dive into in another masterclass, but for the purpose of this masterclass, legacy is typically, multi-generational money. And, how is your wealth going to survive you? What is your legacy going to be with your wealth? For some people, it's very simple. The legacy is going to live through their children. The legacy is going to live through the next generation and the future generation. For others, they want to look at charitable giving. They want to look at, some plans to maybe, donate to institutions or stuff. Maybe they want to have something named after them, a wing in a hospital or a university or something like that. Those are kind of large objectives, but even if it's smaller objectives, even if you just want to set up maybe a small family foundation for yourself and your family, or maybe it's just properly protecting the legacy from the lineal money, right? You want to make sure that your kids and your grandkids and those kids get your wealth, and that somehow there isn't a third party that comes in and gets the wealth. That's the kind of stuff that we want to discuss. Now let's get back to this. Does this sound like you? No business succession plan in place. You're not really sure how much money you need. You're not making the most of the tax advantage retirement accounts. You're debating on how you should allocate your dollars. You're stressing out about the impact. You worry about preserving your capital, but yet you want to produce income for retirement, and you're unsure if you have the proper portfolio for your situation. Well, these are the questions I've been asked. How can my business be sold, transitioned, or liquidated? How can I purify my books before the sale? Should I do a share sale or an asset sale? This is probably a question you've asked yourself. How long will my profits last during retirement? What happens if I want to transition the business to my children? How do I structure my operating and holding companies before the sale? How should I set up my estate in order to maximize my legacy? What tax issues need to be considered and addressed before the sale? And how do I get my business ready for a successful sale? Those questions are difficult, they're complicated, and it's not easy for you. So we're going to go through some of that today. I'm going to do my best to give you some advice on those pieces. Make sure you jot down some notes, because obviously the benefit of a proper business succession plan is you do what you want. You invest in your kids, your grandkids' tuitions. You buy your dream vacation home. Maybe you travel with family and friends. Maybe you have free time for leisure activities and hobbies, the beautiful mountains there. It looks like it's the Rocky Mountains. The bottom line is it's yours, right? It's your time, right? So maybe you spend more quality time with your loved ones. And most importantly, for some, maybe not for everyone, leave a legacy, right? If that's something you want to do. And if it's not, no problem. You still need to, if the legacy is not important for you and you simply want to look at optimizing your wealth, spending every dollar you have, and, dying with $0 in your bank account, that's great. Let's make a plan for that, right? So perhaps you know when you want to sell your business, but you don't have all your ducks lined up in a row. So to achieve a successful sale, in order to ensure you're producing profits and minimize taxes, you need to structure your legal affairs through a well-crafted estate plan. And we call it a business sale plan. So how does your retirement look for you and your family? What might be the best logical successor to your company? Maybe you've thought of this already. How would you like to see the business transition? Is it a slow transition? Is it happening immediately? Are you asked to stay for a few years? Are you a key person in that business? Because if you are a key person in that business, there's likely going to be a situation where they're going to ask you to stay for 1, 3, or 5 years. And typically there might be an earnout on that. So, in order to get full valuation for your business, you probably have to meet the numbers of the sale that you hit in the prior 3 years, or you need to hit some sort of average, or you need to at least grow the business a certain amount. And maybe there's additional earnouts to the business when you're selling. So these things are pretty important when you're planning the actual sale and the details of the sale. And that's the kind of stuff that my dad did a ton of when he was doing corporate finance. So I was lucky enough, for me, my mom was an accountant. My dad was an investment banker, did mergers, acquisitions, IPOs, stuff like that. And he also deal with smaller business transactions, anything below kind of 10 million was kind of his wheelhouse. And there was a lot of 10 to 15 million. And there was a lot of stuff in there that people hadn't thought of. So he was extremely creative, and he was really, really good at structuring deals that were fair for everyone and rewarded everyone based on the output that they generated. So, I benefit from having that background. My dad's still comes into the office every day. I mean, with COVID, it's been different, but aside from COVID, he comes into the office and, he's there. He's there. He's first guy in there, and he's 68 years old, and he still works with me, helping me on the client, senior strategist. He retired about 5 years ago. And then he retired about 10 years ago. And then he was bored, and he asked me, "Hey, can I come back and work for you?" And I said, "Sure, Dad, I got a spot right here for you." So now we work side by side, and he loves this kind of stuff, right? Business succession planning. He loves this stuff. And have you had discussions with your family about selling your business? So the documents that are going to be important include, but they're not limited to, the succession plan, the financial plan, the will, the insurance, the corporate restructuring. If you're doing any type of estate freeze, or if you don't have the proper holdco, opco, investco, family trust set up, you're probably going to need to do what we call a reorg, or a corporate reorganization, or corporate restructuring, because you'll want to make sure that you're able to parcel off a piece of the business and then, effectively cut that off and leave yourself something of value while separating liability from yourself and the buyer of the company. So that's something we're going to get into. Buy-sell agreements. These are important for corporations. Now, here are some questions that most business owners have had to think about at some point in their life, and it applies to business owners when preparing for the sale of their business. So what's the value of your company? How much of that value relies on you working there? You guys have no clue how often someone comes up to me and says, I'm doing 500K annual of EBITDA. Okay, my business should be worth 3 million. Yes, but if you're not there, you're not doing 500K, right? So those businesses are obviously worth less depending on how important you are to that business, right? If the business is you, it's worth less. But if the business is recurring and you could step aside and the revenue would be exactly the same or close to the same, well, that's a very valuable business. That's a much higher multiple, right? If you had died last night with no plan in place, how would your valuation be realized? In an ideal situation, when would you like to step back? How can you make your business an attractive asset for other business owners? When should I pursue an aggressive revenue campaign, and when should I slow down my expenses? Should I include a holdco or a trustco in my corporate structure? These last two questions are incredibly important, because obviously, if you're trying to sell your business, there's going to be a period of time where you're going to want to have all of your revenue on the books. I know how it is. You own a business for tax reasons. Maybe some of the revenue is not necessarily all going on the books, or maybe you're less concerned about the kind of the bottom line number for your company, the profit, if you will. If you're selling your business, obviously it's a very, very important number, right? So you want to start thinking outside the box, or you want to start thinking all the revenue on there and maybe take some expenses out of there. You want to make the business look good, right? Should you include a holdco or a trust in your corporate structure? So typically, if you're incorporated, you probably have an operating company. Bill's Plumbing is the example I always use. So Bill's Plumbing is the operating company. That's the company that does the plumbing. They charge, they collect, they do the plumbing. Now, if Bill wants to sell his company, if he's selling the shares of the company, what's left? So ideally, if Bill is accumulating cash in the corp, he's pulling that cash out, he's putting it in a holdco, and then the holdco is accumulating cash. And over time, if he wants to, he can effectively slice off the operating company, sell Bill's Plumbing to someone else. They hold the liability, they take the corporation, and then Bill only has his holdco left, which is effectively going to be his retirement account for the future. There might also be another layer there with an investment company and maybe a family trust as well, which we can talk about. So the team approach, they say it takes a village to raise a child, and I'm sure you may have heard about this, but with respect to your life, your plan, your wealth, we would agree. We need to we're big believers of being communicating with and being in touch with, whether it's the accountant, the lawyer, all the other tax experts that you work with. We want to communicate with them. We want to be part of that. And typically the way it works is we quarterback with them to make sure we're not missing anything. And that's probably where I get in here too. So we help coordinate the investment advisor, the lawyers, the accountants, the banker, the family members, the business partners, the consultants, all that. Now, family discussions. So some business owners get a clear picture as to who is a successor of their business, and perhaps a child has already approached them. However, it's not always easy to determine. The transition of wealth can cause a great conflict between family members. We see it all the time because, maybe you pass away and it's done through an estate, and it's often perceived unfairness, which triggers anxiety or frustration or family fights, or heaven forbid, lawsuits. Like I've seen it in my own career as a lawyer, and it's not something you want to have. So we're big believers that typically discussions are helpful. They're healthy for a family. And, are there multiple children wanting to succeed you? Will giving a discount or lower price to one child cause disruption to you or your family dynamics? Perhaps you have one of your kids that's in the business, but really only work there because they want to spend time with you, not to succeed you. And then the whole question of, is fair equal, right? Because when it comes to businesses, can two or more family members work cooperatively? Would they want to? How can you transition to them without causing hardship? And then if you gift the business to one other child, what other assets may you leave to your other child? We often see this in farming situations where, the large assets are the real estate, the farmland, and it becomes impossible for business owners, farmers, to even out the estate, if you will, if one of the kids decides to farm and the other ones don't, because the huge value that ends up kind of accumulating inside the farm. So it happens with other businesses as well. So we believe having an open and honest discussion with your family and the potential successors can save time, money, unforeseen disputes. Trust me, this works. It happens all the time. We're really big believers in that. Now, valuations. All right, now we're talking about valuation. You've made some decisions. You're come to the point you're ready to consider an exit plan. That's great, but what's your business worth? What does the value really rely on? What would it cost to liquidate the asset? What's the value there? Can your business be sold as a functional business operation? Do you have to work to continue that for a period of time to smooth the transition? And what does that look like? And the thing with this is that, you could get in a situation where typically businesses sell on a multiple. So if you look at publicly traded companies, if you look at bank stocks, for example, historically, they've traded anywhere from 10 to 20 times earnings. In bad times, they trade at 8, 9, 10 times earnings. In good times, they trade at 16, 18, 20 times earnings. But that's a multiple of the earnings or the profit or the EBITDA, right? EBITDA is earning before income, taxes, depreciation, okay? So if you're making $1 million per year, of profit, of EBITDA, what should that be worth in the market? Well, what's the level of recurring revenue there? How important are you to the business? What are the risks involved with that? How much of it is assets? How much of that is real estate? Is the revenue recurring? Is there any growth to the model? So privately, you can Google this if you want, but most companies in the private space, kind of the ceiling for an established, mature company that's got, consistent revenue, clean books, they'll sell from anywhere from 5 to 8 times EBITDA, depending on the industry, obviously, depending on the sector, depending on, how important you are to that business. But publicly traded companies, they trade at, 10, 15, 20, 30 times EBITDA. Now, we're talking about privately owned companies right now. We're talking about Bill's Plumbing. We're talking about Jamie's Widgets, right? These are companies that do not trade publicly. There's less liquidity. Therefore, you get a smaller multiple for it. So valuation is a very, very big piece of this entire picture, right? Because you could have a business where really the revenue is not really worth anything. You're really just selling the assets. You could also have a business where there are no assets and, maybe it's mostly a cloud-based business, or it's a service type business, or it's a leverageable business where you're able to sell a whole bunch of stuff without costing much. Now those businesses are typically going to be worth more, right? So if you're a business where you're producing something for an X number of dollars and you're selling it for, 15% more, the typical kind of widget creation, value creation business, margins are going to be important. And then multiple is going to be important. Okay, so a long track record is going to be important. What's happening in the industry is going to be important. And how important you are to that business is also going to be important. There are businesses that sell for 1-2 times earnings. 1 or 2 times earnings. In other words, the seller of the business is simply getting another year's worth of profit to sell the entire business today. So in that situation, you could say, why wouldn't he just hang on? Why wouldn't he just stay another year? Well, because obviously they want to sell their business. So that's all they get for it. So valuation is important. So we're talking about the corporation if it's structured for a sale. We're talking about the assets being sold within the company. Now, if you're the outside looking in, would you want to buy your company for that price? So this is really, really important stuff as well, right? Valuations are one topic that we cover so much with our clients. It's just something that happens all the time. It's so important. Most business owners will need to engage their accountant or a CBV to determine the price of the business. This is not something we do, but what I have done and what we do for clients is we talk them through this process. Clients will often come to us and go, what do you think this is worth? Well, I've seen enough of these businesses sold that I can give you a ballpark figure, and then we could start from there, right? So a lot of times I'll tell you that offer's out to lunch, or that's a crazy offer. You should take that. But if you're actually gearing up to do it, you're probably going to want to hire a CBV at some point. Okay, especially the ones that are likely to be more scrutinized by CRA. Now, tax planning. We know that your business is valued at. We like to have an idea of what your cost base is and potentially who might take over your business. So we've talked about the family planning, who's going to take over the business. We've talked about the business is valued at. Now, you can't stop there and call it a day. CRA could get more than their fair share of value that you worked hard for. It is important to do proper tax planning, because the tax planning is where you could save a ton of money. Because in Canada, you probably know this, or maybe you don't, but there is a qualified small business corporation. And if you do meet that, you can exempt tax. If your shares are eligible for the lifetime capital gains exemption. Okay, so this is for the qualified small business corporation, the QSBC. So if your company does not meet the test and you're selling, you need to purify your company. That's what it says here. All right. Did you know that you don't automatically get the lifetime capital gains exemption, and specific criteria must be met? The current exception, and this will increase annually with inflation, $883,384. Okay. So first of all, tax planning. Is your business set up in the most tax efficient way possible? This is corporate structure. Okay, so holdco, opco, investco, family trust, multiple holdcos. Do we need multiple should we have multiple opcos in case you could sell one portion of the company and not the other? Opco means operating company. Holdco means holding company. Investco means investment company. So there could be a situation where you're really doing 2 or 3 or 4 different types of businesses, And maybe you haven't thought of it yet, but down the line, someone might want to simply buy one piece of your business. Maybe you, instead of spinning it out, you could do it now, separate opcos. There might be tax advantages to doing that. The holdcos, if there are different partners, do they each have their holdcos? Do the holdcos own the shares of the operating companies? This is the kind of stuff you should start to think about. How does the holding company or the family trust form part of your plan? Are the passive assets that need to be transferred out of your operating company? So one of the key factors with the small business capital gains exemption is that you cannot have too many passive assets. There is a passive asset test. Typically, it's about 10%, and you can talk to your accountant about whether or not you qualify and meet the eligible requirement for the small business capital gains exemption. But you cannot just keep millions and millions of dollars in your operating company and then sell your operating company, because you will not get the small business capital gains exemption. This is very, very important, very, very critical. So maybe you need to set up a holdco. Maybe you need to set up a family trust. But the corporate structure is critical. How can you minimize your estate by unlocking surplus cash in your holding company? Very effective strategies that can be implemented to utilize the surplus cash within your holding company. Okay, tax planning. Let's keep going here. Could an IPP, an individual pension plan, help you offset a large amount of tax? You've probably never heard of an IPP. These things are unbelievably tax efficient. If you're above 40, if you own your business, if you have top tax bracket or close to top tax bracket income, and you want to contribute more to a registered account, the IPP allows you to make a tax deductible expense. The business pays for your personal pension plan, and it becomes a tax deductible expense for the business. An extremely efficient way, and you can contribute more than you can with RSPs. So it's something you should consider, right? And we do have videos on this. If you haven't checked it out, go to our YouTube channel, check it out. By the way, if you're watching this and you haven't subscribed to our YouTube channel yet, please subscribe, Facebook, all that fun stuff. You need to subscribe to our channel. The success of most succession plans is heavily dependent on the tax strategy. I cannot overemphasize this enough. Tax strategy planning is critical, period. End of discussion. Estate freeze. All right, so let's talk about an estate freeze. So an estate freeze is the process by which you exchange your common shares of your corporation for a fixed value of preferred shares. You're basically freezing a value of your shares at today's fair market price. Therefore, locks in the value and allows newly issued common shares to transfer future growth to your successor. Now, this would be part of your corporate restructuring. If you've never heard of this topic, if you've never heard of an estate freeze, this is a quick introduction, but talk to your accountant about us, or maybe you'll book a no obligation consultation with us so we can chat about that later. But the estate freeze is something that most people have never thought of. It can be an incredibly tax advantageous situation because you get to defer the growth to your successor. Really, really neat stuff that happens here. How could they be accomplished? Via the operating company, with the holding company, with the trust. But which one's right for you? I don't know. But I know that when we meet people, we look at their situation, we figure it out, and we give them the advice. All right, so some business will end up completing multiple estate freezes over time. So what we do here at the Tatro Wealth Advisory Group, we help you determine if an estate freeze is right for you, if it's right for your business, and how that fits into your overall succession plan. Impact on your retirement. So just like all clients, the important determining factor in their ability to retirement is how much do you need comfortably in retirement. Business owners, they're going to require slightly more because they're not used to this, but the business paid for so many expenses, right? So now that has to be paid personally. How should the business transition or the sale be structured to achieve your retirement goals? Think of the dividends to your holding company, the share sale, the share redemption plan, salary, rent, loan payments. This all needs to be factored when we're factoring in your retirement because the corporation no longer exists, right? So this is something most people don't consider, but it is a big, big thing. So the important thought process helps shape most of the decision and cash flow needs because retirement today is not like it was a few generations ago. Most retirees enjoy a second career. They volunteer. They have an active retirement. And most importantly, they live way longer. You're watching this right now. The odds are significantly higher that you're going to outlive the prior generation. And I'll tell you what, your kids are probably going to outlive you if you have children. So it's just standard of life is improving constantly, and we have to plan for that. So when should you draw down each of your retirement assets? How can we maximize the cash flow? And should you take the money from the company, the RSP first? I'll tell you what, if you're looking for a quick answer, the answer is it depends. Because I don't know your personal situation. Some people have a high income in retirement. Some people have low income in retirement. Generally speaking, the tax-free savings account wants to be the last account that we want to save, right? Because that's growing tax-free deferred forever. The RSP, the key with that account is to make sure that we're planning for a proper drawdown of the RSP. So you don't want to die with a $5 million RSP because you lose half of it to the government. As you know, it becomes a fully taxable when the last surviving spouse passes away. So you get the one-time free taxable, non-taxable rollover to your spouse if you're married. But that's it. After that, if you pass, or if you both pass at the same time in a car accident or something, both of your RSPs immediately become fully taxable. So the planning is important when it comes to drawing that down. Now you're going to have a corporate bucket as well. What do we do with the corporate bucket? So this is you got all these buckets of cash. If you were to just say, screw it, I'm just going to start drawing from one of them and who cares? I guarantee you're going to pay more tax. You need to factor income splitting. You need to factor OA, old age security clawback, the CPP. There's a lot of things that need to be factored in when it comes to investment. But the big ones are, salary, dividend from the holdco, opco, whatever's left, and then relative to drawdown of the RSP. Those are the big ones that need to be factored in. Now, the question of how much you need to retire, the 70% rule, I'm going to need 70%. That's a myth because who knows what's going to happen? Are you downsizing? Are you renting or buying? You're going to have extraordinary expenses. I've met people who spend 120% of in retirement because they travel a ton. They want to do more. I met people who spend 50%. This whole concept that you need 70%, I don't buy it. So your pension options at retirement, if you're fortunate to have any type of pension, you might get a defined benefit plan. You might get a defined contribution plan. But if you're a business owner, you might not have any of that as well. Then you have a CPP OAS decision. So, old age security, here's how that works. But basically, if you're retired by 65, then you start taking it. If you're still working at 65, you should defer it. So this is kind of the basic for your CPP and your old age security decision. It's indexed. It's going to grow over time. You can defer it if you'd like, but it's clawed back if you make too much money. CPP, the maximum is $1,175. That's going to grow a year. You can defer to age 70. It is indexed. You can start it as early as age 60. The math on this is basically if you live 14 years, you're better off. If you live longer than 14 years, you're better off deferring. So think about that. We don't know when we're going to die. If we knew exactly when we'd die, we'd make the planning pretty darn easy, but we don't. So we make the best decisions based on the actuarial death calculations. That sounds morbid, but it's something we look at. And then how you're feeling, how much you want to spend, family history, etc. We take a look at all that, right? And then when we get into the maximums for CPP, here's some stuff for maximums for CPP. The 14%, if you defer, if you take it early, take it at 65, or if you defer, that's what that chart looks like. I'm going to come through that here. The tax rates, there's some tax rates for you guys, what it looks like, tax impacts. Here's some other important documents for you, taxation impacts that you need to consider. Talk about income splitting here. In retirement, this is incredibly important, income splitting. If you're not doing this properly, this is a couple that we met. Sounds ridiculous, but they weren't doing proper income splitting. We're saving them $7,734 every single year, just by having proper income splitting in place. So after you sell your business, you're going to want to consider that. Talked about the drawdown strategy for the RSP, when you should do it. As a part of our analysis, we want to determine the most tax efficient way to access your funds in both the current year and over your lifetime. So basically what we do when we make a plan for you is we take a look at, 2022, 2023, 2024, where are the dollars coming from? How are they being spent? What happens to the rest of the wealth? How is it growing? Do we need to make asset allocation adjustments? And then if they die in this year, what happens to their assets? If they die in this year, what happens to their assets? And how much tax are they paying this year, this year, this year? And basically with software algorithms, we calculate the optimal way to make sure you pay the least amount of tax and you have the most amount of money for you to enjoy your retirement. You've sold that business, it's time to enjoy it, right? Now, investment planning in retirement. So obviously my passion is investments. I love investments. I love planning, but I really, where I've cut my teeth and where I've built my reputation is on building the best portfolios in the country. And that's something that I love. I'm incredibly passionate about. I believe investment planning is something that most people, they don't consider it enough, right? And it's something that I think is incredibly important. Traditional portfolio theory. So, I want to talk about this briefly. You're going to have sold your business, right? You sell your business. All right. So now you have $1 million, $5 million, whatever the number is. You sold your business. I know that if you go to a traditional investment firm, one of the larger institutions that advertises everywhere, they're going to build you a standard 60-40 portfolio. These portfolios are the same portfolios my dad was building in the 80s and then in the 90s. These portfolios do not make sense for this decade, for 2020, 2021, 2022 in Canada. The reason being, interest rates have changed dramatically, and you just can't get yield in fixed income anymore. If you don't know what I mean, a 60-40 traditional portfolio means 60% of your portfolio in stocks, 40% in bonds. That 40% in bonds, trust me, I do this all the time. I take a look at portfolios. I see people send me their statements. I pull up their holdings online. They have net negative return on 40% of their portfolio. Happens all the time. If you've not looked at your own portfolio lately and you think you have a balanced portfolio or a 60-40 portfolio, I guarantee you have some holdings in there that have a negative return for the next 5, 6, 7, or 8 years. I guarantee you there are some holdings in there. Why would you want to own that? It's not what I believe in. There are different ways to protect capital better than losing money on your investments. In fact, that's the opposite of wanting to protect capital, right? So again, we do things differently here. I want to talk very briefly here about a fiduciary obligation. So a fiduciary obligation is the highest standard of care that exists at law in a client-professional relationship. It requires the fiduciary to act at all times for the sole benefit and interest of the client. It's an enhanced level of protection for the client, and it's in fact the only way you should be operating if you have money invested. Now, most of the countries on the planet have this in place. They have a fiduciary obligation, and the individuals managing money professionally, guys and gals like me across the country, in most places, are all fiduciaries. In Canada, however, the vast majority of investment professionals are over here either as mutual fund salesmen in an MFDA role or mutual fund saleswoman, or in this channel, which is the regulatory channel, as an investment advisor. That means they do not owe you an obligation to act in your best interest. They do not owe your wealth an obligation to act in the best interest of your wealth. If you can believe that this is happening every single day across the country in Canada, that's why you hear stories of people getting screwed on fees or people getting taken because there's front end, there's back end fees, there's trailers, there's hidden stuff, there's compensation paid from the mutual fund company, all sorts of things that would never exist if you worked with a fiduciary. So who's a fiduciary? Anyone who's got the portfolio manager designation in Canada is a fiduciary. And you guessed it, I'm a fiduciary. I'm a portfolio manager. So allocation, why it matters over time. And I can get to this. I'll cut to the chase here. Modern portfolio theory needs to be adjusted and is being adjusted, but a lot of advisors out there are still operating with a mentality that they were doing 5 years ago, 10 years ago, 15 years ago, and they've not adjusted. So there are asset classes that perform in all markets, and I bet you've never heard of them. How would you feel to own an asset class that doesn't move on a day-to-day basis, stays exactly flat? The shares are always at $10, but annually you make 7, 8, 9%. That would be something that you'd want to consider, right? You don't have to worry about China. You don't have to worry about what happens in the political world. You don't have to worry if there's a world war or a global, macro event. You could just rest at night knowing that your assets are there and they're going to be there and it's going to grow. That's the kind of stuff that really gets me going. That's the kind of stuff we do for our clients in their portfolios. So to recap, we talked about business succession planning, talked about the important documents, the team approach, talked about preparing your family for the discussion. We talked about the valuations, right? We talked about the tax planning, how important it is, corporate restructuring and the estate freeze. We looked at the impact on your retirement, traditional portfolio theory, what a fiduciary obligation is, asset allocation for retirement, and why it matters. So common problems that we see. So businesses are not structured properly pre-sale. So that's the corp structure. We need to look at the corp structure. Team of professionals are not on the same page. You have no idea what you're going to get for your business. It's not optimized for tax efficiency. You've not taken the opportunity to put more money in your pocket. You've not optimized your books for your sale. You're not prepared enough to maximize the profits on the return of the sale. You're unsure of the cash flow needs. You have a complex financial situation. You're enduring losses, or you disagree with the successors and families. We see this all the time. This is the kind of stuff that we see, okay, when people come to us. The solution, you got it. You partner with us. You partner with us. We build and create a custom tailored retirement plan and investment portfolio according to your goals and needs. This is what we do. We work with business owners across the entire country. Again, background lawyer, finance MBA, my dad with 50 years of experience, mergers, acquisitions, business sales, having sold some businesses myself, having seen the impacts of my clients selling their business and the pitfalls, what they've gone through. We are incredibly positioned to advise you on this stuff. So you benefit from the following thing: retirement, estate planning, personal corporate investment planning, tax and financial planning, insurance planning, and then some. So this is our team. That's my dad there, his lovely mug. This should probably be changed to 50 years experience. But anyways, Derek, Jean, Karen, as we keep going, my sister, Adam, Bus, Jean-Luc Laflèche, Esther, Carrie. So this is the team. That's the Tatro Wealth Advisory Group. And this is me, my background. I talked about it already, but there I'm going to show my age here. But I have a Juris Doctor, Faculty of Law, University of Toronto, MBA of Finance, Dean's List, Chartered Investment Designation, a couple other things there that we've done over time. I started this branch, this Canaccord Genuity branch in Winnipeg. It's one of the proudest accomplishments in my life. One of the fastest growing branches in the entire country. And I'm really, really pleased to be the branch manager. Now, what if partnering with us meant that you could put more hard-earned money in your pocket, peace of mind, evaluate the facets of your structure, brought in thousands of dollars, saved on taxes, managed the communication with your accountant, saved you time, allowed you to leave a multi-generational legacy, expert in guidance through a family trust, optimizing your business strategy? What if you got all that? Right? That'd probably be worth half an hour of your time, right? I would imagine. So obviously the benefits, you address the emotional attachment. We assess thoroughly the business valuation, the exit strategies, more time to enjoy the things you want to do, help purify your corporation, secure the sale for optimum tax efficiency, less stress knowing you've partnered with experts, difference between feeling excited. All right. Now, what to expect from us? It's a custom business sale plan, thorough financial planning session, a multi-award-winning group ready to serve you and your family, professional advice, constant access to anyone on the team. We make the transition to our team seamless and effortless. We're always available for support, world-class analytic research and investment solutions. I don't know if you know this, but Morgan Stanley partnered with us. They chose to partner with us. Morgan Stanley in the US chose to partner with us for their Canadian partner in wealth management. And we have access to all of their research. It's pretty impressive. State-of-the-art online portal for easy access to your accounts. It is extremely user-friendly. Why now? You're the one selling your business. Maybe you're not selling it today. Maybe you're not selling it in 3 years. Maybe you're not selling it in 5 years, but you own a business. And at some point, you may sell it, and you need to get your ducks in a row. You don't want to leave this in your spouse's hands if you pass away. You want to leverage the expertise. The opportunity cost of not surrounding yourself with professional experts is something you can't afford. Like compounding profits from a sale over a lengthy period of time can have significant impact on your wealth. Respectfully, if not now, when? I mean, there's a reason you're still watching this video, right? Now's the time. Now's the time. So here's how it works. We do a discovery call. We get to know you and you get to know us. We identify the areas you need to help with, whether it's tax planning, business structure, investments. We schedule an in-person meeting, probably via Skype or Zoom at this point. We address the facets of your business, your goals and needs, legacy, planning. And then you join the team. You become a client. You maximize top dollar for your business. right off into the sunset. You retire. The money comes in every month. We take care of managing the assets. You just do what you want to do in retirement, which is what you've been thinking about your whole life when you built this business, right? I love this. I love this little chart here. Taxes you paid, taxes you could have paid, lack of planning. There's back of the napkin, as we call it around here. Now, there's a chart on fees here. So what do you pay for the partner with us? So we charge a fee based on assets under management. Depending on how much you have, it varies on the situation. Some require more work than others. At $1 million, it ranges anywhere from 1 to 1.25. As you grow above that, it's more. Below that, it's a little less. Sorry. As you more assets, that's less assets, it's more. Sorry about that. There are no hidden fees. As a fiduciary, I cannot hide fees. Everything will be transparent. It's always going to be on your statement, and it's tax deductible in your non-registered account. I love transparency. My grandpa told me when I was building this business 12 years ago, be honest, be transparent, and work hard, and you're going to be successful. And that's what I did. That's how I decided to build this business. So it's extremely competitive. And then what I'm asking you to commit to right now is a discovery session with me personally. So if we find out your goals, your needs, we analyze them through financial management. You get actionable, valuable financial advice that you can implement. And at the end of the call, you're going to have a very clear vision of what you need to do in order to maximize profits from the sale of your business. So how do you do that? You book your call. You go to www.speaktorob.com and you book your call, and you do that now. You do that today. www.speaktorob.com. You could book it directly in there with a Calendly link. You'll be able to book it. It'll show up in my calendar. I will show up on that call, and we're going to have a half hour, no obligation, absolutely free advice about you and your business and how I can help you. Absolute worst case, you get some free advice that you can take to your spouse, take to whoever, your business partner, and you can start implementing. All right. Best case, I have a feeling I'm going to identify some holes in your planning. I'm going to identify some tax savings. I'm going to identify some ways that we could purify your some corporate structuring advice, some estate planning advice. I know because I do this all the time. And every time I meet with a business owner, it's always the same story. Busy, successful, but extremely focused on their business. And the rest is details, right? So if you're like that, trust me, we can do huge wonders for you. And even if you're not like that, even if you think you've got every base covered, I guarantee you don't. Unfortunately, there's so much that goes into this. There's so much that, that we've seen. I have the benefit of having seen hundreds of transactions, hundreds of business sale transactions in my life, in my career. And now I'm offering to transfer that advice onto you. So that's my email, rtatro@cgf.com. Send me an email if you want, but go to speaktorob.com to book your call. And, there's some testimonials here. You know what I'm going to do instead of showing you these testimonials? Go to Google. Go to Google right now, put in my name, and you will see all the Google reviews. These are published Google reviews of my current clients that have gone out and said, here's what I think about Tatro and his group, about the Tatro Wealth Advisory Group. And go and read that. Read the testimonials that are published on Google. All right? This is real. So the final thought I'm going to say is you deserve a successful sale. So you've worked hard your whole life. You've done it. You've built this asset. Now you're about to sell it. Imagine if selling it improperly would cost you hundreds of thousands of dollars. Hundreds of thousands of dollars. You can't afford to screw this up. You just can't afford to screw it up. All right. Hopefully you enjoyed watching this class as much as I did, as much as I enjoyed making it for you. If you got questions, please send them my way. But the best thing you can do right now is go to www.speaktorob.com. Book the call now. All right. It's time for you to improve your outcome. Thank you so much. Have a great night. Thanks for watching. And we'll be in touch. You'll be in touch when you go to www.speaktorob.com.